This is Retirement Everything They Never Told You. I'm Doug Harding.
And I'm Joe Wirbick, Certified Financial Planner.
And of course, Joe, you forgot to mention, you are the CEO also of Sequinox Wealth Management, Sequinox.com. Oh, you don't agree with that one?
No, I agree wholeheartedly about that. I am the founder, I am the president, I am the CEO of Sequinox, yes.
Okay. Well, we're going to talk about a lot of things, and I can't really guarantee you what we're going to be talking about today. But Joe, I worry about a lot of things, and right now I'm a little bit worried about the market and market volatility. I know it's been up and down over the past couple of days. Should I be worried? What's the future? Do you know? Or how do we predict, or how do we plan for it?
Well, if I knew what the future was wholeheartedly, Doug, I would not be on this show.
Okay.
I would have my own island. And I would relax on that island with my trillions of dollars. Nobody knows exactly what the future holds. And was it Yogi Berra who says, I hate to make predictions, especially about the future, something like that? I know he's got the best quotes. I never liked you and I always will. Just great, really fun quotes. But all I can do, Doug, is I can look at the past.
Right.
I can look at history. And historically speaking, markets have pullbacks. They're normal. I think they're healthy. Because I don't think it's healthy for a market to, we saw at the beginning of the year, we saw about a 20% pullback, not quite in every one of the indices. I think we hit about 15% in the S&P and the Dow. The NASDAQ was down about 20% during the tariff debacle that we ran into. And then we had about a 30% recovery, just a straight up recovery, which is great for our pockets, but not great for the market. I think it puts a lot of strains in the markets. We start seeing PE ratios, price to earnings ratios, get out of whack. That's where the price of the stock is not in line with the earnings of the company. But at the end of the day, I know I'm a broken record.
Okay.
I think the economy's strong. I think companies are earning. I think there's profits there. There's cash there. So should you be worried about a stock market correction or a stock market bloodbath? Well, I guess I'd have two questions for you. Are you retired, Doug?
I am not retired.
So that means you're earning money.
Correct.
Some fashion. In some way you make money.
I like to think so, yeah.
So that means you're not spending your portfolio currently.
Currently, no.
Are you investing in the market currently?
Yes, I am.
Like on a monthly basis?
Yeah, I do that. In my portfolio, my IRA, of course, I'm always investing in that. And I do some side investing as well, just not a whole lot. I do a little bit of crypto. I dabble in that. And, I have a small Robinhood account. So I kind of do that on my own a little bit, but nothing where I'm going to have huge gains or huge losses.
So you're currently investing in the market. You're not spending your money. So the next question I'd have for you is, when you invest in the stock market, do you like to pay high prices for stock or low prices for those investments?
You know something, I've learned a lot, especially when I talk to financial advisors like you, is, buy low. That's what I like to do.
Yeah. So are you picking up what I'm putting down here, Doug? You're investing every single month. You want to buy stock when it's low. Mm-hmm. You're not spending your money. So you don't need the corpus, you don't need the majority of that money right now. So why would you be worried about a stock market correction when you don't need this money for maybe 5 or 10 years?
Well, because I have this bad habit of checking the market every single day because it's so easy on your phone to do that. And then I see it go up, I'm really excited, and then it's down a couple of days.
But what's more important to you? The value of your portfolio when you're not spending it, or the value of your portfolio when you're spending it?
Probably spending it.
Yeah, without a doubt when you're spending it. So if you're not retired, people, I know this is a long-winded way to get there, but if you're not retired, you shouldn't be worried about the stock market. You should just be buckling down, doing your job, doing whatever it is you do, and just keep dollar cost averaging. I heard you mention crypto. Bitcoin was over 100,000. Now it just broke below 90,000. So if you're buying Bitcoin, you're probably happy, or you should be happy, that you're buying it below 90,000 and not at 100,000, because that's cheaper. So that means the money you're sticking into it is buying more of a coin than it was a few weeks ago. And historically speaking, not guaranteed because past performance is not indicative of future returns. We've seen the stock markets go up, have corrections, and then go back up again. It's healthy, it's normal. But for some reason, we all get angina, we get concerned, we get worried. I'm okay with corrections as long as the overall economy is strong. And there are people who are out there saying it isn't strong, but I look at the numbers. Unemployment, low fours. Inflation, sub 3. Cash on the sidelines, over $7 trillion, Doug. Do you know what that means? I mean, can you fathom how much 7 trillion is?
I'm going to think about that now. Elon Musk is, what is he, almost a seventh of the way there?
Yeah, I mean, he's a seventh of the way there of 1 trillion.
Okay.
And he doesn't have cash. He won't have $1 trillion of cash. He'll have stock or the equivalent of stock. I'm talking about 7 trillion of cash just sitting in money market accounts. And the last time I checked, I will have to fact check myself here, and maybe we'll throw it up on the screen. I believe there's somewhere around 9 trillion of US dollars in print.
Jeez.
Okay. So we're talking about almost the equivalent of the entire US currency sitting in money market accounts.
Huh.
And
not getting much.
Half of US currency that's in print is held overseas. I don't even know if you know that, but the majority of, not the majority, but I think it might be a little bit over half, so I guess it would be the majority of US dollar bills that are held as dollar bills are held by foreigners. So we have $7 trillion in currency. We have low unemployment. We have low inflation. People's incomes are historically at an all-time high. We have more American adults working. We have 180 million people between the ages of 18 and 55, and Americans tend to spend more Americans tend to spend more until age 65. So all of that tells me that this is more than likely, not guaranteed, small correction.
Okay.
Markets will pull back. People will realize that, hey, maybe they're taking some profits and then they'll buy back in. But the thing I love about this stock market, which is different than it was 20 years ago or 30 years ago, is the largest portfolios, the largest investments in America today are in people's 401ks. And they're dollar cost averaging. I don't know the number. I'll have to look it up. I think it would be a cool number to see how much money flows into the US stock market every 2 weeks via 401ks and 403bs. So we have this life support system that's being pumped into the stock market, whether the market's up or whether it's down. And it's interesting because before we had 401ks, you mainly had the wealthy investing in the stock market. It wasn't individuals. It was the elite, the millionaires. They were the ones buying in. But now we have so many Americans who have 401ks, who have IRAs, and they don't choose when their 401k investments go in. They just go in automatically. They get paid, money goes into the pot. And maybe if they had the choice, they might freak out and say, oh my gosh, the stock market's falling, don't put money in, which again would be the exact wrong thing to say because we know you want to buy low and sell high. So we kind of have this autocorrect in the stock market in that every week millions of dollars flow into it because of 401k. So long-winded answer, if you're working, I wouldn't be worried about it. Now, if you're retired, that's a different story, Doug. Because if you're actively pulling money from your portfolio on a monthly basis to cover your expenses, I am going to put a little prayer in for you and hope that you don't have 100% of your money sitting in tech and growth stocks. I mean, if you do, I love it. You're a risk taker. Hopefully things work out for you. I hate to say it. I'm saying hope a lot. And a financial plan should not be built on hope. So if you're retired, you should be working with an advisor. You should be working with a planner. And that individual most likely would not take 100% of your money, stick it in the riskiest, most aggressive stocks, and then give you an income from that. So more than likely, you're diversified. Diversified means you have some money in high risk, you have some money in safety. That's a very simplified version of diversified. And so why you do that is we call them non-correlated assets. And what that means is
Mm.
you don't want everything inside your portfolio to go up at the same time and then to go down at the same time, because that's going to hurt you if you're drawing from that portfolio as the stock market is going down. So that's why you diversify and you have some safety, so that when the markets fall, maybe only a portion of your portfolio is falling, while another portion is staying strong, or heck, maybe it's going up at the same time. That's what diversification is. That's what non-correlated means, that they're going up and down at different times. So you're not going to open up your 401k, excuse me, let me change that. You're
Okay.
not going to look at your entire portfolio,
Uh-huh.
because if you're retired, your entire portfolio should not just be your 401k. It should maybe be different investments, different options, because your 401k, this is another thing we should talk about, Doug.
You know what, Joe? I was going to bring that up because I had a question for you about 401ks, but I want you to finish up your thought here real quick.
Well, it's going to make some noise here because I can still see you on the computer screen. I keep wanting to look down at you. I keep wanting to look at the screen. I should be staring at the camera. So Doug, 401ks, they're the underlying investments. A lot of them are crap. They're just not good. You know, they're gonna give you, maybe they're gonna give you one growth fund, one value fund. They're gonna give you a mid cap, a small cap, and what that means is a medium-sized stock company, a small-sized company, okay? And then they're gonna give you like 40 lifestyle funds. You know, they're gonna say the 2026 fund, the 2027 fund. They're gonna go the whole way out to like 2060. I hate those funds, Doug. I despise those funds because they give people a false sense of security.
Why is that?
Because people make the assumption, and we all know what an assumption is, Doug. We've all heard the terminology before. We all know what an assumption does. They make the assumption that, okay, I'm going to retire in the year 2030, let's say.
Okay.
So if I buy the Lifestyle 2030 fund, that means the closer I get to 2030, the safer my investment is going to be. Isn't that what you would think, Doug?
I would assume so. Yeah. So, well, see, there's that word again.
There's that word again. You said
Yeah.
it. I set you up. I set it up. You knocked it out of the park for me.
But I'm not totally sure about it. That's the thing.
Yeah. See, that's the issue. They give you that false sense of security. And here's what that fund is made up of.
Okay.
Stocks and bonds. That's what's in there. Okay. And you would think, okay, well, stocks, I've heard that stocks are maybe more aggressive and bonds are safer. I mean, when you hear bonds, you probably think, oh, that's debt. You know, a bond is a loan to a corporation or to a government that they're going to eventually pay back, right? So you think a bond is safe, right?
Mm-hmm.
But the problem is, inside that lifestyle fund, they don't own you don't own any individual bonds. See, if you went out and you bought a bond, say you bought a 10-year bond, okay, what that tells you is that as long as the institution you lent the money to, because that's what a bond is a loan, it's debt. You bought debt. You're in essence lending money to that institution. As long as that institution is still in business, they're still solvent at the end of that time period, you will get your money back. That's why people like government bonds, because they're like, hey, the government's not going to go bankrupt. I'll get my money back. So if your portfolio is actually made up of individual bonds and say stocks, then you could say, okay, that bond portfolio will peg that portfolio that all the bonds will come due in the year I retire, so I'm going to get my money back. But that's not how these funds work, because the fund will never, ever, ever hold a bond to maturity. They just won't. They're going to trade those bonds exactly like stocks. And that's the issue. And because these funds are trading the bonds like stocks, the performance of those bonds become more stock-like. And so what we see is that safety is eroded away. That safety is stripped away from that bond, and it becomes a bond in name only, but not in action, not in results. And so I'll give you the perfect example. I've said it before. I'm going to say it again.
All right.
Picture the year 2008. When I say that, what comes to mind?
2008 reminds me of the crash of the housing market.
Yeah, the housing market fell. We had the bubble. It crashed from September of 2007 to March of 2009. The stock market fell over 54%. Massive losses.
Yeah.
It was September of 2008, Doug. I was sitting down with a soon-to-be retired postal employee who had a lifestyle 2009 fund. It's
Okay.
September of 2008. He's 3 months away from retirement.
Oh boy.
His 2009 fund was negative 45%.
That's rough.
So think about that.
Yeah.
His safe fund has lost nearly half of its value 3 months out from when it's supposed to be your retirement date. That is a false sense of security. And Americans, if you're listening, if you're watching this and your portfolio has those lifestyle funds in it and you just check that box because it's easy, that may not be your best option.
You know
I'm
something?
just saying it's not as safe as you think it is.
You know, it's funny you bring that up because I recently had to sign up for a 401k and I had a financial friend of mine help me out. And all he did was roll his eyes at what I had options to.
So he did the same thing I do.
Yes.
I roll my eyes every time I see it because it's the same. It's 30 lifestyle funds, one growth fund, one value, one mid cap, one small cap, one bond, and one stable value fund. And it's like the people who build these portfolios, they just say, okay, one from column A, one from column B. We got a great allocation here. And it's hurting Americans. You know, if the stock market never fell, it wouldn't hurt Americans.
Sure.
If the stock market just went up and up and up, everybody would be fine. It's the fact that it's a false sense of security. I don't like that. I don't like that. And I don't know whether the representative of the 401k company actually goes to the people and explains what I just explained to you. I doubt it. I don't even know if average advisors explain to their clients that a bond fund is not a bond, that a bond fund is just as risky as a stock fund. So that being said, and we talked about this at the beginning,
Right.
if your portfolio is made up of, I'm going to have 60% stock funds and 40% bond funds, you basically have almost 100% equities because we saw bonds back in 2020 lose as much as stocks did. So when everything came crashing down, the equities, stocks lost money and bonds lost money because they're tied to interest rates, and the interest rate environment changed and the value of the bonds fell. So again, that's why I say non-correlated assets. Maybe you need to have investments inside your portfolio that aren't tied to the stock market at all.
Okay. That sounds fine to me. Like what?
Some people say, well, that's precious metals. Well, historically speaking, here I go again, historically speaking, gold has underperformed the stock market, and in most crashes, like in 2008, gold plummeted right along with the overall portfolios of the average individual's investments. So I'm not a big precious metals guy, but safety. You should have safety inside your portfolio. And I think as you get older, the level of safety should increase. Safety doesn't necessarily mean low returns. Safety just means that there's a portion of my portfolio that is not going to fall when the stock market falls. It's that simple.
Okay. So safety in your retirement. So how often do you see clients come in? Maybe they're coming in for the first time and you see all this unsafety. They're in bonds and they're in the market, like the 60-40 part, and they have no idea how risky they are.
100% of the time.
Oh, wow.
So I have in my software that I've spent the last 6 years developing, when I input all the client's data, I get this sort of, I call it a grid, and it has cash, safety, and risk. And it shows the percentages. How much do they have cash? How much do they have in safety? How much do they have in risk? And I will say, Doug, 98% of the time, cash is 1 to 2%, safety is 0, and risk is 98 to 99%.
Ooh.
And the look on the individual's faces, when I put that up on the screen, the risk is in the upper right-hand corner, and I can see both spouses looking in the upper right-hand corner, and going, well, Joe, I'm confused. Why does it say that 98% of our money is at risk? And I'll explain what I just explained to you, that equities are risky and bond funds are risky. Well, I have bonds. Yeah, you have bond funds. Now, if you have a government bond, that's not going to go up in the risk category. It's going to go in the safety category. You have a CD, which I used to call certificates of depreciation, but right now, because they're ahead of inflation, CDs aren't bad, but they're gonna get bad because Powell eventually is going to lower rates, and CDs are going to go back down to the 1-2% part where they were for years and years. So unfortunately, I see it all the time. And one of my jobs as an advisor is to get some of that money moved over into safety, into some investments that are not correlated on the downside to the stock market, meaning if their stocks fall, I don't want their safety to fall as well. Kind of simple, but it's a little bit complicated.
Well, to me, it sounds very complicated because I'm not a financial planner like you. But what scares the heck out of me is not knowing that you're not safe in your portfolio.
Definitely.
It's crazy.
Yeah, I mean, you can have a massive portfolio if we have a true bear market. Now, what's the difference? Bull market is when the markets go up. Bear market is when the markets fall. And I don't think we've seen a bear market. It's almost hard to say that 2020 was a bear market because the peak to trough, the high to low was so quick during COVID.
Right.
Yeah, that would be a bear market, but that wasn't a protracted bear market. In my mind, the last true bear market we had was 2007 to 2009. 2012, we had some corrections. 2020, we had corrections. But I don't know if I felt that was a long, drawn-out, grueling bear market. And so you say, okay, 2001, we had one with the NASDAQ when it lost 50%. So if I'm right, which I may not be, but let's just assume I am because I like that. If I'm right, in 25 years, we've only seen 2 protracted bear markets. And I think that has a lot to do with what we said at the beginning of the program. Every single month, money is flowing into these equities. Every single month, people are dollar cost averaging in the stock market, and that is building up the market to have more safety than it had before. Not 100% safety. We are going to see corrections. We are going to see the economy change. But I will say this, from a month ago to today, the economy hasn't changed enough for me to say, why did the NASDAQ fall 6%? Why did the Dow fall 4.5%? Why did the S&P fall 5%? When I don't see a big enough change in the economy, that tells me it's a short-term correction.
Okay.
Yeah, we saw that Powell said I might not lower interest rates in December, and that's kind of what triggered this. The October 29th meeting is kind of not the ultimate highs because the Dow came back and had another high just about a week or two ago. But the S&P and the NASDAQ, that was kind of the high point. Powell said, we're going to lower rates in October. We're not going to well, didn't say that. He said the rate decrease in December is not certain.
Okay.
And as I've said hundreds of times, if you watched any of my videos, the stock market hates uncertainty. It hates an unknown future. And so when Powell says, I'm not sure, markets can react to that.
Okay.
So I feel this is a correction. Can't be guaranteed. Could it become a correction? Because I say correction, the official definition of a correction is a 10% pullback. And right now, the NASDAQ is only down about 6+%. So it's not at that 10% pullback. It would need another 40% decline to hit that 10% pullback. So, which would then be a correction. But if it happens, it happens. And like I said, Doug, you should be okay with that because you're still working and you're still investing, and that's positive. If you're retired, hopefully you have a good plan. If you don't have a good plan, what can they do, Doug?
Well, they can call you because bottom line is you need a plan no matter what. If you're pre-retiree or in retirement, and I mean, heck, Joe, all this 401k, stock market talk, it's a little bit confusing to me, and I'm sure it's confusing to maybe a lot of people watching this right now too. And so that's why you step in and you help people build these plans so you can relax.
yeah, I don't like when it sounds confusing. I try my best to make it not confusing. So, when I hear that, I feel like I failed in what I just
No,
went through
no, no,
there.
no, no. You're not being confusing. I'm saying the whole area of it, the whole part of it
Yeah.
is
Yeah.
confusing. And see, that's why, we're doing the show so you can explain all this in simple terms. But the bottom line is, having somebody in your corner to help you out to make it less confusing, if you want.
Agreed. And that's what we do every day. So that's what's going on in the economy right now. We're uncertain. The markets are uncertain. We're coming to the end of the year, so we could have that Santa rally.
Hey, hopefully so. Let's
You know,
spend.
we could have people go out and start spending some money to buy those Christmas gifts because, oh my gosh, I'm out at my place in Arizona and every one of the resorts around here have all their Christmas lights up and they have happy holidays. And I'm like, guys, it's not even Thanksgiving yet. When we're recording this, we're still not even into Thanksgiving and we're
Mm.
suddenly into the Christmas spirit, which don't get me wrong, I enjoy Christmas, but can we just wait until we're at Christmas or at least December?
Well, I mean, have you seen Christmas in July?
I try
I
to
know.
ignore it when I see it. I
Me
really
too.
do. I mean, look, I love certain things, but that doesn't mean I want those things every single day of my life.
Hmm.
I really do feel that when people say, what's the secret to life? Everything in moderation. That's it.
Okay.
You have your favorite food, have it in moderation. You like snacks, you like sweets, you like ice cream, have it in moderation. Everything in moderation. And that really, you can live a pretty good life, which would come back to investments.
Okay.
Your investments, everything in moderation. Don't put 100% of your money in Bitcoin. Don't put 100% of your money in that growth fund if you're about to retire. Everything in moderation can carry you through just about any aspect of your life, Doug.
All
Kind of
right.
simple.
Yeah, simple as that. Moderation is, we'll leave it at moderation. But I want to go back to the holidays and spending. Do you like to spend more money on other people, like giving gifts, or
Oh,
do you enjoy receiving gifts?
I had a mother who was a very giving person,
Mm-hmm.
and that rubbed off on me. And so I am much happier giving gifts. Don't get me wrong, Doug. I enjoy a good present. I'm not saying that I don't enjoy getting a good present, but if you had to ask me, I would say that I get more enjoyment out of giving something to somebody. And I have these soundproof foam things on my wall and they keep falling off during our discussion. So if you see things hitting me, I watch here, you know what? We're gonna get off topic here for a second.
What? Okay.
I watched a YouTube video about how you should install these soundproofing foam and the video lied to me. It's not working. So just because something's on YouTube doesn't mean it's real. Although I'm saying that and you're watching me on YouTube. So I don't know if I should be saying that, Doug. The difference is I'm a certified financial planner and that guy was just a moron who told me how to install these things. They're wrong. But getting back to Christmas and getting back to giving, I enjoy giving more than receiving. How about you, Doug?
You know something, I love giving more than receiving because receiving a gift and people are watching you open it, it always makes me feel, a little bit uncomfortable. But seeing somebody else's expression and you got them a good gift, that's gift enough for me.
But how bad is it when the expression's the other way and you realize you got him a terrible gift?
Well, here's something I've done before is I used to do this to my nephew every year is I would purposely get him white tube socks just to watch him go, oh,
Oh,
that was my gift to myself, watching him do that. But of course, I got him other stuff as well.
I had a friend a friend in high school, and I actually dated his sister, which is kind of not good, but we worked it out. And they had the best Christmases. These people, just their Christmas was so fun, and they had an aunt, and she was devilish. She would pick somebody, and she would spend months, and she would get the smallest box she could get. She'd put the present in that, and then she would wrap that box in tape. And I don't, and then she would do another box and another box and another box. And this woman would get maybe 10 or 15 boxes wrapped in scotch tape and duct tape and packing tape. And then the entire time the individual was unwrapping the gift, she would just cackle and she would laugh. And she had so much enjoyment out of watching this poor person see are you kidding me? There's another box. And then they would get through that box and go, oh my God, there's another box.
So what would end up in the tiny box? Would it be like a keychain or a little whistle?
Yeah, sometimes it would be absolutely nothing, and then she would hand him the real present. I mean, it was just watching them go through this process of excitement and then depression and then excitement and then depression. She would laugh so hard. I mean, she would almost pass out. She would giggle, and it made everybody else laugh. So it was just such a great time. I always loved when her gift came up because it was just a pleasure to watch.
Who's going to be the victim of this year's Christmas? But what do you think about this? Giving gifts to your kids and having a proper estate plan, is that a really good
that's
gift?
Important.
Okay.
That's important. A proper estate plan is important. Setting up the estate in such a way that it helps and doesn't harm, and making sure that the estate is set up in such a way that the stuff, and that's a very highfalutin term there, that your stuff goes to the people you want to receive said stuff.
Right.
So you have to have a few documents in place to gift, because that's what it is. It's a gift. It's a gift at death. You're saying, I've died. This is all the stuff I have. And these are all the people I want to receive my stuff. And I'm no longer here to give it. So I have to leave instructions behind so that my desires are carried out. It's that simple. Okay. So you have to have a few pieces of paper prearranged before you die, because you can't do this after you die. So you got to make sure you plan ahead and not post-death. You following me, Doug?
I totally follow you. You know what? It always seems like when I hear the word estate, that I'm some super rich millionaire and have a mansion, but that's not the case with this, is it?
No, estate is your stuff. That's your estate. And what's happening in America, I don't know if you're aware of this, but the average home value is about $465,000. So we're saying that the average value of at least a part of the estate's close to $500,000 today.
Right.
And then if you've saved in your retirement, you might have another $500,000. So we're getting to that point where these estates will start becoming $1 million estates. And that's a lot of money that you want to make sure goes to the correct people. And you want to do it in a way that has the least amount of fees and the least amount of taxes. So we can start off with the basics, Doug, because that's what everybody likes. It's a will. Everybody needs a will. Do you have a will, Doug?
I certainly do. And
you do?
It was really kind of weird when I put one together, because that really made me think of the inevitable. But I had to do it.
So when you think of the will, and you named people in the will to get your stuff.
Correct.
Do you feel, and then just answer accordingly or however you feel, do you feel that that will handle your estate?
Well, here's the thing is, when I initially did it, I thought it would, but now that I'm more into finances, like talking with you every week, then no, I don't think so now.
You don't now, but you think the average person probably thinks if I get a will, I'm good.
Yes, exactly.
So when we talk about this, and I have, oh man, I try to do educational seminars every month, Doug.
Okay.
And the last 3 months, I've done just 1 or 2 days a month. In Lancaster. You know, if you guys are listening out there, I'm sorry you're not in Lancaster area to come to the presentation, but I've done a wills and trusts seminar. And unfortunately, the venue that I hold this in only holds, say, 30 people. But for each date that I've done it, I've had over 100 people try to sign up.
Wow.
That tells me that people are dying for this information. People are, they're dying for this information.
Hey, that's a
that
good
was
joke.
a pun. Did not try that. I love when I can crack myself up. My friends, when I was a kid, they called them, my name's Joe, but I was Joey back then. And they actually called them Joey jokes. They were jokes, and I would tell the joke and I'd be the only one who laughed.
Yeah, I'm like that too. I'm my own best audience, and people just roll their eyes at me too. So
so I still call them Joey jokes. Anyway, that tells me people really want this information. So the will take care of your house, the stuff inside your house, maybe your bank account, maybe your automobiles, and that's about it. Because there's two different ways that money passes. It passes by law or by contract. The will is the law side. Contract is any beneficiary.
Okay.
So have you ever filled out a beneficiary form, Doug?
Yes, I have. A couple of times, yes.
And what type of an account was it?
It was my IRA, actually. Yeah.
There you go. So your IRA, because it has a beneficiary on it, will bypass the will. So if you name a certain number of people in the will and different people in the IRA, the will doesn't control the IRA because the IRA has its own beneficiaries. That passes with no lawyer, that passes with no cost. Whoever you name on that IRA, that individual shows up. They say, I'm the beneficiary. Here's a death certificate. The money passes. The lawyer doesn't get involved. There's no fees. But it's not just your IRA, Doug. Have you ever had a life insurance policy?
Yes, I have. I've done that as well.
Beneficiaries on that. Your 401k, beneficiaries on that.
Just did that.
Yeah, so your retirement accounts have beneficiaries. I don't know if you know this, but every single, every single investment can have a beneficiary on it. So if you have a brokerage account at Vanguard, if you have a CD at the bank, if you have your own IRA, your own Roth IRA, all of those will have beneficiaries and all of those accounts will pass outside the will. So it can get kind of confusing. You'll want to review who you have in the will, but also who you've named on those other accounts because the two will not interact with each other.
I didn't know that.
So you have to be very certain that you're naming the right people and that you're naming primaries and that you're naming contingents. Because if the primary dies before you and you don't change the beneficiaries, that means that the money can't go to them because they're dead, so it'll go to their contingent. Unless you use per stirpe or per capita, which now it gets even more confusing. So most beneficiaries will default to what we call as per capita. So let's say, do you have any kids, Doug?
I have no kids. I'm not married, no kids, nothing.
Okay, well, you are a terrible person to choose for this example.
All right, I have 4 kids. I have 2 cats and a dog, and my wife.
I didn't mean that. Okay, so you have let's say you had 2 kids. Let's just keep it simple. If you name your son and your daughter, you name 50% to your son, 50% to your daughter, and you don't put anything else on there, and you leave it at that. And let's say both of your kids have kids, so you have grandkids. Okay. If you have nothing written on there but their names, most likely the company will default what's called per capita. Per capita means that if both of those kids are alive when you're dead, it's simple. The money goes to the son, the money goes to the daughter, we're done.
Right. Okay.
If, however, one of those kids predeceases you and you don't change the will, then per capita says, oh, one of the primary beneficiaries predeceased the bequeath, the giver,
Okay.
the owner of the contract. So one of the beneficiaries died. So per capita says automatically that money goes to the other primary beneficiary, not to the grandkids.
Okay.
So that's bad for some people, because some people think, oh, if I name my daughter and my daughter dies, it'll go to my daughter's kids. It won't if you don't write in. And here's the word you write in, and maybe we can have it show up on the screen. It's per stirpe. You write in per stirpe, and then if your daughter predeceases you, it goes to your daughter's kids, not your daughter's husband. Because I know I talk to my clients, they love their daughters. They may not love their son-in-laws, just the way it is. Sorry, son and daughter-in-laws out there. You're not the same. And you know what? You mean nothing compared to the grandkids. So if you want to make sure that the money goes to your grandkids, if you're not going to change the forms every single year, then you got to name the kid and then put per stirpe afterwards. If that person predeceases you, it goes right to their kids. It's pretty simple. Just always write per stirpe in if you want to make sure it goes down the bloodline.
Per stirpe. All right. I learned a new word today, but I didn't learn this word because I hear it repeatedly and it gripes me, and that word is taxes. Do we have to worry about taxes making an estate plan, especially the gift to the kids?
So there's a thing called the death tax. Have you heard of that?
Uh, I just look at it all as like that. I'm a negative Nelly right now. No, what is that?
So this was brilliant. The Republicans did this way back, I think, in 2000. We had an estate tax. It was a federal estate tax. Okay,
Okay.
back in the 80s, Doug, the federal estate tax was as low as $180,000. It meant
Hmm,
that if your value of your estate was above $180,000, your beneficiaries would have to pay a federal estate tax.
I didn't know that.
Okay. Then over time, that got larger and larger and larger, but it wasn't getting massive until the Republicans. If I said Democrats, I was Republicans. Until the Republicans came up with the idea, let's not call this an estate tax, because, like you said, Doug, when you think of an estate, you think of wealthy people, right?
Exactly.
So they said, let's not call it the estate tax. Let's call it the death tax, because everybody dies. And if we name it the death tax, then people are going to be they're going to be in the streets. They're going to be chanting, down with the death tax. I'm going to die. I don't want to pay a death tax. And it worked. And so it went from $180,000 back in the 80s. You know what it'll be January 1st of 2026?
I have no idea.
$15 million per person.
That's gone up quite a lot.
Oh, it's gone up exponentially
Yeah.
because they were brilliant in their marketing of the estate tax. They called it a death tax. People rallied that we raised it. So that means if you're married in 2026, you can give away $30 million with no federal estate tax. Do you know what percentage of the population has an estate above 30 million?
It's got I guess we call it the one percenters, right?
No, it's 0.09% actually.
I was
It's less
close.
than 1%. It's less than 1%
All right.
above $30 million. So what I'm saying to the average person out there is you don't have to worry about the estate tax. There's no federal tax if your estate, and that 30 million gets adjusted for inflation every single year. It's going to get bigger and bigger and bigger.
Okay.
Signed into law. It was part of the One Big Beautiful Bill, the OBA as we're calling it, because I don't want to keep saying One Big Beautiful Bill. We're just going to say OBA,
Oba.
not ABBA. Great band,
Oh yeah.
but we're going to say OBA. Okay. So OBA, because that was going to go away. That was going to go from 15 million down to 6 million, but they put that in. So now we're at $30 million. So the average person doesn't have to worry about that, but your state may charge you an inheritance tax.
Okay.
48 of the states, 47 of the states don't do that. So most listeners, if you're not in Pennsylvania, you're good. If you're in Pennsylvania, I'm sorry, Pennsylvania is going to charge you 4.5% to 20%. That just stinks to die in Pennsylvania. Or just don't be a resident of Pennsylvania when you die. You don't have to worry about it. So there's not really a big tax to worry about, Doug. And unless the money is in an IRA, it's going to pass tax-free to your heirs. Did you know that?
Okay. No, I didn't know that. No.
So if you have money outside your retirement accounts, your home, your CDs, your cash, your mutual funds that aren't inside a retirement account, they get what's known as a step up in cost basis. So whatever the value of the account is on the day that you die, that is the beneficiary. So I was talking to a client yesterday, and this is where the step up in cost basis isn't really helping him. His father died back in 2022, I want to say, and he inherited Eli Lilly stock.
Eli
And
Lilly.
at that time, the portfolio was worth about 250,000. So his basis was 250,000. So if he sold the stock, then he would have paid no capital gains. Unfortunately for him, unfortunately, it's gone up about 300% since then.
Wow.
So
That's great.
So now, because it's grown since his father passed, now he has gains in that portfolio because he didn't sell it when he inherited it. And he made the right decision because it went up 300%. So that step up in cost basis is only good for the day the person dies. Any gains after that, you will have to pay tax on those. Then IRAs are taxable because no one's paid the tax. That's called an IRD, income in respect of a decedent. That means that when you inherited that IRA, more than likely they're going to give you 10 years. They're going to force distributions. They're all going to be taxable. So that's why I hate dying with IRAs. That's why everybody should have a Roth. You get a Roth, you die, it's inherited tax-free. It gets to grow 10 years tax-free. There's no required distributions. And in the 10th year, it all comes out tax-free. So make your life simple. just invest in Roth IRAs and Roth 401ks and you'll be good.
All right. Do we want to do a whole entire show on Roth IRAs? Because I think we could. Or do you want to hold off some other time?
Yeah, we don't have time today. We could do an entire series on Roth IRAs. We can do a week's worth of Roth IRAs. I love them so much. They're so great. But I think we covered wills. Two other things I want to throw in there. You need a will. You need a living will. And you need a power of attorney. So if you're out there listening and you're an adult, which you're probably an adult because kids aren't going to listen to this, those are the three documents everybody needs. The will takes care of the stuff that doesn't have beneficiaries. The living will says, hey, if I'm hooked up to machinery, keep me hooked up to machinery or unplug me. And then the power of attorney says, hey, if I'm incapable of making financial decisions, like paying my bills, I need to have somebody else out there make those decisions for me, and they have to have access to my account so they can pay those bills for me. So that's why I'm saying every adult should have a will, a living will, and a power of attorney. Most attorneys will put that together for you in a package deal and just get all three documents. You need to have them. Do you have them, Doug?
I do have them, yes.
Oh, yeah. You have them because you talk to advisors like me all the time. So
I do.
You know this stuff.
Yeah, I get all sorts of great financial information from financial advisors like you. But what if somebody needs to talk to you about that? They can get in touch with you. What do you like, being called or emailed or what?
You know, what's great is we have so many different ways. You can scan the QR code on the screen. You can call the 1-800 number on the screen. You can visit www.sequinox.com, and there's a link right there to set up an appointment. We are available for anybody in the country. We work with people in all 50 states, and what we do is we build a financial plan for you. If you don't have a financial plan and you want one, where we talk about everything in here that we discussed today. We talk about making sure your estate's set up so all the money passes with the least amount of taxes, the least amount of fees. We'll show you how to get that income where it needs to be in retirement. We'll try our best to make that income 100% tax-free. And we'll make sure that your portfolio doesn't have too much risk. So when things like this, which is little pullbacks in the market, occur, you don't care about it because you know you're okay. It's a free financial plan. You call that 800 number, you scan that QR code, you go to our website, you get set up with one of our certified financial planners, one of our advisors. They'll build that plan for you. We'll give you that plan, and you won't be one of those individuals out there worrying about, do I have enough money? Am I going to be okay in retirement?
Well, Joe, thank you very much for that information. And there's the phone number, QR code, the website, Sequinox.com. We're going to come back next week. And Joe, we're going to have another fantastic show because of you.
Well, because you have to tune in every week because guess what? The stock market changes, the economy changes, these crazy politicians are going to say something stupid and people are going to overreact. And if you want the real scoop, without the BS, without the hey, if it bleeds, it leads. We're not here to sell fear. We're here to sell facts. So check us back every week. If you enjoy content like this, make sure you hit that subscribe button. Make sure you turn on that notification bell because that will tell you when we post new content. And as always, I'll see you next week.